Well, good morning, everybody, and welcome to the 26th Annual Business Forecast Luncheon. This luncheon is now 26 years old, so here's my first bad joke. That means we're getting kicked off our parents' insurance this year. Thanks, Dad. Anyway, each year at the Business Forecast Luncheon, we invite you to forecast the values of 15 economic indicators for the upcoming year. You have a green contest form at your table. We then give out awards to the top 3 forecasts, best forecasts, overall forecasts, and then 1 award to the Dow Jones Industrial Average forecast. So I will first announce the winner of the best Dow Jones Industrial Average forecast, and then turn to the overall forecast winners. Our contest participants, that's all of you here in this room, last year produced a consensus forecast that the Dow would only grow by about 5% and end the year at 24,500. Now, of course, when you did these forecasts in January last year, the stock market was obviously doing very poorly, so it undoubtedly led to some poor guesses on your part. Well, unfortunately for your predictions and your contest forms, but fortunately for your 401ks, the stock market actually performed pretty well. The Dow ended about 4,000 points higher than you predicted it would. And so our winner for the best Dow Jones Industrial Average forecast is Denise Anderson. Denise, please come up to the stage and receive your award. What you need to know about Denise as well is that Denise is a Walton College graduate, so double congratulations to you. So before we move on to the overall forecasting awards, I want to take a moment to remember a special friend of the Business Forecast Luncheon. Dan Grubb passed away 6 years ago and was among the people who helped push for the inception of the Business Forecast Luncheon 26 years ago. He was a steadfast supporter of this event. He would always turn in his contest form and even won the contest one time. In his honor, we've named the Best Forecaster Award the Dan P. Grubb Award for Best Economic Forecast. Can I please get a round of applause in memory of Dan's important contributions to Northwest Arkansas? Thank you. Now I'll announce the 3 best overall economic forecasters from last year. Our third place forecaster is Dan Zhao of Simmons Foods. Dan recently completed her MBA from the Walton College, so double congratulations to her. Our second place forecast winner is Zane Chenault from the Fayetteville Chamber of Commerce. Last year, Zane was appointed the Chief Economic Development Officer for the Fayetteville Chamber. Congratulations, Zane. And the top spot, the Dan B. Grubb Award for Best Economic Forecast, goes to Preston Smith with Signal Point Asset Management. Congratulations, Preston. Good job. Yeah. Well, congratulations to all of our forecast winners. Let me remind you once again to please fill out your contest form, give us your contact information, particularly your email, and turn the page around and fill out the event evaluation on the reverse side of this form. Now, as a good millennial, I'd be remiss if I didn't tell you about social media. The hashtag for this event is BF2020. The college has a Twitter account at UA Walton College. The college is also on Facebook and Instagram. Probably next year we're going to be on TikTok as well. But this event is also being recorded and will later be on YouTube. So if you're watching this on YouTube, please smash that like and subscribe button somewhere around here. Let me now welcome Matt Waller, Dean of the Sam M. Walton College of Business. Everybody knows Dean Waller's academic credentials, but did you know that he's also an innovator In fact, he's co-founded 2 businesses and has a U.S. patent with his name on it. Matt?
Thank you, Mervin. Hello, I'm Matt Waller, Dean of the Sam M. Walton College of Business. Welcome to the 26th Business Forecast Luncheon. At the Walton College, we're creating educational programs and degrees specifically to open up opportunities for Arkansans. One such degree is our new Masters of Science in Economic Analytics, which you saw the video beforehand that was talking about it. All sorts of companies here in Northwest Arkansas and throughout the heartland are looking for people trained to harness the power of the ubiquitous data that's now available everywhere. A quick reminder to join us at the Arkansas Business Hall of Fame dinner next week in Little Rock, Friday, February 7th, where we will induct 4 more outstanding business leaders: Gerald Alley, Olivia Farrell, Charles Nabholz, and Rennie Rutledge. It is now my pleasure to introduce our moderator for today. Claiborne Deming is chairman of the board of Murphy Oil Corporation, where he previously served as president and chief executive officer. He also serves on the board of directors of Murphy USA, and previously served on the board of directors of Entergy Corporation. Claiborne was inducted into the Arkansas Hall of Fame in 2019 and was the driving force behind the El Dorado Promise, which awards graduates of El Dorado High School a scholarship equal to in-state tuition and mandatory fees for bachelor and associate college degrees, a proposal that changed the academic culture of El Dorado. Please help me in welcoming Claiborne Deming. Sure.
And thank you, Matt. I'm delighted and flattered to be here. This event underscores the dynamism of Northwest Arkansas and its entrepreneurial underpinnings. And those of us in South Arkansas are really, really proud of what you've done. Thought I would help set the scene today with my esteemed colleagues with some general observations about our economy. But let me start with a conundrum. Our market-based economy, despite being the most effective creator and spreader of societal wealth in the history of mankind, is under attack. Socialism famously distributes misery, and markets, conversely, create and distribute value and make everyday life better for all of us. Margaret Thatcher perhaps said it best: socialism is great until you run out of other people's money. And very importantly, market economies driven by competition reinforce the values that most successful and durable societies are built on. Hard work, because it's rewarded. Deferred gratification, people are encouraged to save. Self-reliance, because you have to look out for yourself. Accountability, you have to stand behind your word in a market economy. And then importantly, compassion. Americans are the most generous people on the planet because we know we're the luckiest people on the planet. So query, why is our system, which is so effective and reinforces great values, why is it under attack? I think there are 2 primary reasons. First, I believe there is likely something to the inequality discussion we're having as a country. Periodically, large wealth gaps appear in dynamic market economies, especially when they are massively disrupted by innovation. I'll give you 2 examples: the Gilded Age 1870, 80, 90, when the Industrial Revolution swept across America, created large fortunes. Secondly, the digital age, happening right now. Great innovators and risk takers saw a once-in-a-lifetime opportunity and they seized it. Outsized fortunes were made. And I'm glad they were made because it spurred innovation that we all benefit from. But outsized fortunes make some people uneasy. And secondly, I believe public markets are arguably not operating as effectively as they were intended. Why? I'm not exactly sure, but I think it's a combination of programmatic trading, hedge fund short-termism, activist investors, some are good, some are opportunists, have served to distort our public markets. And as a result, there's a feeling the system in some corners is being gamed. And it's perhaps better said that a sense that people who are not bringing real value to society are being rewarded. And this encourages cynicism and alienation. So is there anything to do? Well, I'll reiterate, we have the best system. Yes, it has flaws, but it hands down is the most effective in the world at creating and fairly distributing wealth. And couple this with the fact that these dislocations typically self-correct. And think shirt sleeves to shirt sleeves in 3 generations. And also because the cure is likelier worse than the disease, I submit we don't tinker too much with this. But I do have couple of modest suggestions. One, we have to educate kids more about our market-based systems versus the other options. We can empirically prove, if it's honestly presented, and I think that's an issue, that market-based systems are superior. Secondly, we have to be engaged as individuals and with our institutions and defend and promote markets. And also, we have to be willing to discuss and admit flaws in markets because they sometimes have less than optimum effects or outcomes, because this builds credibility. So we have work to do, both offensively, education, and defensively, actively protecting our extraordinary economic system, literally the envy of the world. Thank you very much. So let's get on with the show. Before introducing our first panelist, let me review for you how today's program will work. Each of our experts will give a brief overview of the economic outlook in the area they have been invited to talk about: the global economy, the U.S. outlook, and the forecast for Arkansas. After our panelists have spoken, we will have a discussion where you can submit questions on the green index cards located on your table. These will be collected just after the state and local speaker has finished, and we'll bring them up here and we'll draw from that for many of our questions. So let me introduce our first panelist, Constance Hunter. Constance is the chief economist for KPMG in the United States. She heads the macroeconomic research, analytics, and forecasting for the firm, and is a member of the KPMG Pension Advisory Board, where she advises on pension investment decisions. Hunter works closely with the firm's leadership and clients to identify the inflection points, risks, and opportunities that arise in the constantly evolving economic landscape. She is known for correctly calling economic indicators that signal market turning points. And Constance, we want you to tell us those today. She's the president of the National Association of Business Economics. Please help me welcome Constance Hunter to the 2020 Business Forecast Luncheon.
Clay, thank you for that kind introduction, and thank you so much for having me here today. It's a pleasure to be here speaking to all of you about the U.S. and global economy. There we go. So the title of my presentation, Can the Fed Inoculate the U.S. and Global Economy, is a timely one. The Fed put in 3 rate cuts last year. These rate cuts were so-called insurance rate cuts, and they impacted not just the U.S. economy, but as we will see, the global economy. And that is because the Fed sets interest rates not just for the U.S., but for the world economy. And so the transmission mechanisms move from the U.S. outward to the rest of the world, and then circle back to the United States. So when thinking about the U.S. economy, even though we're the largest economy in the world, and we have a relatively closed economy, that is, trade does not make up a very large percentage of our GDP, there are multiple transmission mechanisms that connect us to the global economy. So when we look at the situation in the global economy, I think it's important to think about a concept economists call potential GDP. Potential GDP is the sum of the growth rate of the working age population plus the growth rate of productivity. And productivity is really the holy grail for economics. So if we look at the OECD, that is the developed economies in the world, we can see that potential GDP has been slowly declining. And the main culprit here is the fact that we are having lower birth rates. And so working age population growth is basically expected to be flat over the next 3 years throughout the OECD. And what this means is that the entire burden of potential GDP begins to fall on productivity. In the United States, we have a better picture. We have a stronger growth rate of the working age population, but we still have a significant decline from recent decades. And in fact, the census just released their latest figure, and what it shows is that population growth was slower than previously anticipated. Now, there are 3 main reasons for this. The first is that birth rates are lower. The second is that immigration rates are lower. And the third is that life expectancy is lower. And life expectancy is lower in certain cohorts where we see the so-called deaths of despair. Deaths of despair were first identified by Angus Deaton and Ann Case, and they look at people that are effectively committing suicide by high alcohol consumption, opioid addiction, and other drug problems. And so this is the first time in America's history that we have actually had falling life expectancy. And it's a serious problem that we are starting now to see in our macroeconomic statistics. In addition to the human suffering, this has feedback effects on potential GDP. Oh, there we go. What we see around the world is also a slowing pace of inflation. And in fact, most central banks have failed to meet their inflation targets over the last decade. So if we look in European countries, that has been almost 99% of the time they have failed to meet their inflation targets. Switzerland has failed to meet its inflation target 100% of the time. The US is doing a little better at 60% of the time, and Australia and the UK have succeeded largely because they have small open economies, and changes to their exchange rate allow them to import inflation. So this wasn't caused by a big increase in demand, but rather fluctuations in their currency. So when we put all this together, we have a challenging situation for central banks to engineer higher growth. And as a result, central banks around the world are keeping interest rates loose. We mentioned earlier that the Fed lowered rates 3 times in 2019 to ensure that the economic expansion continues. And if we look, this is not the first time the Fed has done this. So they did this in the 90s twice, And in both times, it was because we saw global weakness. We saw weakness in the interest rate sensitive sector of manufacturing, and the rate cuts were able to elongate the expansion. When we look at the current situation, it's similar. There is a slowdown in manufacturing globally, although recent data has come out this month which show that there's a possible turnaround in Europe. And there, you can see from this chart that there has been a turnaround in China. If we look deeper into what is going on in China, China really drives the global manufacturing cycle. And this is important because China is now the second largest economy in the world, and it's a very different situation than in the 1990s when the Fed enacted those other two bouts of insurance rate cuts. Now, you see a slight pickup here in manufacturing. That's the yellow line, and that is because of these three Fed rate cuts. But what you don't see is a real pickup in financing within the Chinese economy. And this is because China is really reaching the natural limits of the amount of debt that it can have within its economy. Its non-financial debt is close to 200% of GDP. So this is corporations that are not financial firms plus households. And 200% of GDP has proven to be a sort of natural limit, if you will. So if we look at when Japan's debt bubble burst, they were a bit above 200% debt to GDP in non-financial corporates. And so they had their debt bubble burst, and they had their working age population begin to decline at the same time. Then we look at Thailand in '97, or Spain in 2008, or now we're in the situation of looking at China. So they are limited in the amount of expansion they can achieve in their economy by increasing the credit impulse. And so as a result, when we look at what's going on in China's economy, we want to look at proxies other than GDP, because GDP data is very smooth and therefore not always a great indicator to see what's really going on in the economy. So here we're looking at imports. And we can see that this decline in imports is indicative of a decline in demand in the economy overall. Now enter the coronavirus. So this is a comparison to the SARS outbreak in 2003. You can see that it reduced consumption and reduced GDP. And one of the things that we are looking at is how this will feed back into the global economy and how this will impact US growth. So we looked back at the SARS epidemic. We also looked at the Fukushima earthquake. So just to refresh your memory, the Fukushima earthquake occurred on March 11th, 2011. March 11th, as you may recall, is the very end of the first quarter of the year. And yet, there was enough supply chain disruption from the Fukushima earthquake to cause US GDP to be negative 0.94% in the first quarter of the year in 2011, a year when economists were largely expecting that first quarter growth to be positive. So when we model in this impact of shutting down a major hub within the Chinese economy and a major center for manufacturing, even though it is a small portion of China's economy, the network effect of shutting down the Wuhan region and effectively elongating the New Year's holiday for an additional week, we see pretty significant feedback loops. And we'll talk about that a little bit later, but it's one of the major risks to growth in the first half of this year. And we think that we could see a negative print either in the first quarter or second quarter as a result of what's happening with the coronavirus. Now going to trade. We've had the phase 1 deal, and that has allowed us to lower tariffs on Chinese goods. So if we look at the average tariff on Chinese goods going into 2020, we're at 19.3%. Now this is below the peak seen in 2018, but it's obviously much higher than the 3% rate that we had in place before the trade war was started. And of course, we expect this to have a continuing lingering effect on trade between US and China. With regard to its impact on certainty within the U.S. economy, which is an important factor when we think about corporate investment. One of the things that many economists believe has held back corporate investment in 2019 was as a result of increasing trade uncertainty. So let's look and see if that uncertainty is going to be removed from the Phase 1 deal. So the Phase 1 deal expects that China will increase imports in a variety of categories from the 2017 levels. And this is important because 2019 imports from the United States to China are lower than 2017. So from the 2017 levels, we see an increase of 39% for 2020 and 64% for 2021. From 2017, it's a much higher increase, 58% from this year and 86% to 2021. Now, given the fact that China's economy is going to be crippled by the outbreak of the coronavirus in the first half of the year, that makes achieving these targets even more dubious. And so the impact that this will have on sentiment and on corporate investment is really something that we are watching very closely, and we do not consider that to be a sure thing for 2020. All right, delving down more deeply into the United States, one thing we can say for sure is that the consumer has been the backbone of the expansion. We've had 111 consecutive months of jobs growth, and that jobs growth has really buttressed consumer spending. We see consumer spending remaining the backbone of growth going into 2020. And if we look at the GDP data released this morning, in fact, without that strong consumer spending, we would have had a negative GDP print. So the consumption slowed in the fourth quarter, and most importantly, it slowed in the durable goods area. So things like automobiles, home appliances, that pace of growth slowed in the fourth quarter. Nevertheless, we had consumption a little bit above 2%. We also had an interesting feature of the fourth quarter GDP, which was that we did not import very much, right? We had imports actually be negative. And normally, that is an indication that there is soft demand within the importing economy. However, we think that this is due to distortions because of trade, and we see a lot of imports that were brought forward earlier in the year, and so that fourth quarter decline in imports caused trade to be a positive contribution to GDP. That's not something that we're necessarily looking for in the same magnitude going into 2020. All right, let's think a little bit more about the consumer and delve down into the types of jobs that consumers are getting. So when we compare this to 1995, you can see a really significant change in what we call routine work. And it doesn't matter if it's routine manual work or routine cognitive work, there's been a significant decline. And the rub here is that those 27% of jobs which were routine manual work in 1985 were all fairly well-paying jobs. When we come into 2019 and we only have 20% of workers in routine manual jobs, we have fewer workers in middle skill, middle pay jobs. The positive here, though, is that we have many, many more workers in high-skilled, high-paying jobs, that non-routine cognitive work. And this lays an interesting groundwork for future growth and future labor force productivity. If we look at other aspects of the consumer, one thing that's really important to consider is how fast can consumption grow in 2020. Like I said, we've had 111 consecutive months of jobs growth, and that has allowed the consumer to be very strong. We are expecting the pace of jobs growth to slow from a year-over-year pace of about 1.5% at the end of 2019 to gradually fall to a pace of 1% in 2020, and this is largely due to the fact that we're at a 3.5% unemployment rate. We don't have that many more additional workers coming back into the labor force, and our population growth is running anywhere from 75 to 80,000 people a month. And so if we just keep pace with population, that puts us at about a 0.9% year-over-year growth rate in jobs. And so when we combine this with some other factors, the fact that credit is tightening for consumers, we expect to see a slower pace of consumption going into 2020. We also see some cracks within households, so we see an increase in auto delinquencies and a slight increase in credit card delinquencies. All something we're watching on the edges to see if we're being too optimistic or if we are going to need to ratchet down our consumption forecast for 2020. Now, a big area that I mentioned earlier, durables, one of the biggest components of that is autos. And auto consumption has really flatlined in the United States. We think we've reached sort of a saturation level at around this 17 million autos per year. But one thing that's really turned around as a result of the Fed rate cuts is housing. Housing was very sensitive to mortgage interest rates above 4%. And now that we've seen approximately 100 basis points come off mortgage rates, we're seeing a rebound in housing. So you can see that here in the last 2 quarters, housing was a positive contribution to growth, and we see a turnaround in housing starts and private investment in housing. Now, one note of caution, housing is normally a leading indicator. So it is something that turns before an economy goes into recession. Now, we had an extreme situation in the years leading up to the financial crisis. But if you look back to the beginning part of this graph, you see that housing turned negative before the 2001 recession, and then it rebounded before the recession went into force. This is a normal occurrence in the housing market. So just because housing has turned around does not mean that we cannot have a recession. In fact, the signal from housing is much more in line with suggesting we are due for a recession sometime in the next year to year and a half. Delving again into the workforce, one of the things that's very striking about the U.S. labor force is that we now have more human beings between the ages of 65 and 69 working in the labor force than we do people between the ages of 16 and 19. And this is because we've had a dramatic shift in labor force participation. The younger workers are choosing to be in school and doing things other than working, increasing their education, while the older workers are working at a much higher rate. So almost 37% compared to about 22% in 1990. So this is a long-term trend. We expect this could go up even further, and it's an important feature of why we have been able to keep this very, very low unemployment rate for so long without triggering significant wage increases. So if we look at the total composition of the labor force, just like the types of jobs have changed, the type of worker has changed. So workers over 55 now make up the overwhelming majority of the labor force. People are often surprised by this. So if I ask audiences, which segment of the labor force do you think is larger, baby boomers or millennials? Most people raise their hand and say it's going to be millennials, but you can see from this graph that it is actually baby boomers. And this is a really interesting thing to keep in mind when thinking about marginal propensity to consume, marginal propensity to save, and the impact on the economy. Another thing about demographics is that millennials and Gen Z are the most diverse populations in history. This is also going to impact consumption factors going forward. Finally, we see that millennials are much better educated than previous generations. So in line with Gen X, but very, very different from baby boomers and the silent generation. Much more of them have bachelor's degree, and much more of them have some college education. Feeding this back into the types of jobs that we're seeing in our economy, those non-routine cognitive jobs, this is a very positive outlook for future productivity. I know it's odd to say that because when we look at the productivity numbers, we don't have a very good story to tell. Productivity has not grown in line with previous expansions. So even though it is in the short term a very significant worry, there are a number of factors underlying the economy which make us think that we could have a surprising productivity surge sometime in the next decade. One of those factors is the age of the capital stock. Now, this has been a puzzle for economists for the last 15 years or so. Usually when the capital stock gets this old, we see further investment in that capital stock. But we have not yet seen that. And when we combine this with what has been going on with investment throughout this expansion, it's a big puzzle. And when we look at what's happening within the labor market in terms of the type of jobs being created and the increase in education of the millennial generation, we're actually hopeful that this is not a permanent state. We're hopeful that we're going to see some increase in productivity sometime over the next decade, which is really fortunate because, as I mentioned, it is the holy grail for economic growth, and we are not going to get increased growth as a result of population increases. So where does this put our forecast? We have a yellow dotted line here. That is our so-called soft landing scenario, and you can see that that's at about a 1.6% rate over the next year and a half. But because of several factors, we think that it is much more likely that we will get shocks to the U.S. economy, which put us in a mild 1/4 decline of GDP. So let's run through those shocks and how they're likely to work. When I explain this to people, the best way that I've come up with explaining to non-economist audiences how the modeling actually works is thinking of a Jenga tower. So I'm sure everybody in this room has played Jenga. You're familiar with how the game works. You stack up a bunch of blocks, and then you gradually pull out those blocks. And if you pull out too many of them in a certain combination, what you're going to see is the tower is going to fall over. It works very similarly with shocks to the economy. So if we think about some of the shocks that could occur, some of them are not necessarily going to cause the economy to falter. In fact, if we pull out a couple of the blocks, the 737 MAX exports, trade, corporate debt, we see the tower begins to wobble a little bit. It's not as stable as before we pulled out those shocks. If we add to that the effect of the coronavirus, what we see, ooh, that was too quick. Let's go back here. There we go. You're supposed to just, ooh, okay. What we see is a fall of that tower, and that is a good analogy for how the economy begins to be impacted by these shocks. So our estimate is the lack of exporting the 737 MAX is going to take about 50 basis points off of GDP growth in each of the first 2 quarters of the year. Then we fold in the shock of the coronavirus and the many transmission mechanisms that takes, whether that's equity market prices, whether that's actual trade, whether that's confidence in corporate investment. And we feed that all through, and that's how we get to a negative 0.2% GDP print in either the first or second quarter of this year, which we expect a rebound from, right? We expect the Fed to respond to this if it starts to happen, and we expect the economy to bounce back. The one caveat to that expectation is this debt that I mentioned in the Chinese economy. So as you know, when you have a high level of debt, what starts to happen is you spend a lot of money repaying that debt and not putting it into other productive uses. That is sort of the situation that China is in. And if you are in that situation and you have slowing growth, it becomes much more difficult to meet those debt payments, and you could have that be an accelerant to the slowing growth because of the virus. Okay. I mentioned at the beginning I was going to talk a little bit about how U.S. monetary policy impacts the rest of the world. And of course, when we have tighter monetary policy, all things being equal, the dollar is worth more versus other countries. And if we have looser monetary policy, all things being equal, the dollar tends to lose value. So this is a graph actually of world trade per unit of GDP, and it has been falling, and it has been falling in line with a stronger dollar. So the Fed, by lowering rates in 2019, was able to slightly weaken the value of the dollar, was able to increase liquidity to global bond markets, dollar debt issuance began to rise again, and we saw looser liquidity conditions around the world. And so the Fed was able to help not just the US economy, but the global economy. And so it's one of the reasons that the main headline for my talk is rates low for a long time. I think the outlook for US and global rates is one where it would be unlikely to see long-term rates. If we look at the 10-year bond going above 4.5% sometime in the next 3 to 4 years, it seems very unlikely. And unless we get that productivity surge, it seems really unlikely for the foreseeable future, given the potential GDP. So with these low rates, what I would say is I would encourage all businesses to continue making investment, continue thinking about how you can improve productivity within your organization, and the cumulative effect of that will hopefully be greater productivity throughout the whole economy. Thank you very much.
Thank you very much, Constance. Our second panelist is Manuel Balmaseda. Manuel is the chief economist at CEMEX, a leading global building materials corporation. Previously, he served as chief economist for Spain and Europe at BBVA, chief economist for capital markets at BBV, and a professor of economics at SIMFA, and a visiting researcher at the Federal Reserve Bank in Minneapolis. He's also vice president of the National Association of Business Economics. Please help me in welcoming Manuel Balmaseda to the 2020 Business Forecast Luncheon.
Thank you very much.
You're welcome.
First of all, thank you very much. Thank you very much for the Walton College of the University of Arkansas for the invitation. Thank you very much to Mervin, Marianne, for having me come here and share some views with you of how I see the global economy. Right? When you look at what's going on, and Constance mentioned it, the global economy is not doing that poorly. The US is in its longest expansion ever. The global economy has been growing, slowing down but growing. Stock markets at record levels, right? So on and so forth. But it seems like we've been in a crisis for 10 years, right? So the question is why? And I'll try to share some stories with you and try to see how much of it I can convince you of what might happen. Right? So at the end, I think the summary of everything I'm going to say is in the title of the presentation, is the show must go on. I think all policy, like in the movie, if you've seen the movie, all policies are aimed to continue the show going on. Right? So monetary policy, doesn't matter, no worry about inflation, we have to keep this going. Same thing with fiscal policy. So the question is, can that happen? And given that we were very close to the Oscars, I figured that having a few movies to go through it would be a nice way of going through it. So I'll try to go through 4 movies in my 24 minutes. The first one is, I know the never-ending story doesn't have a question mark, but I figured I had to put one in, because if not, it would be too easy. I could have called it Titanic, and then it would be obvious, right? But no, I don't think that's the case. Then Easy Money, A Few Good Men, and Risky Business. So do we have a never-ending story? I was lucky that Constance went before me, because that way, a lot of the numbers she went through, so I don't have to go through the numbers. I can just go and tell you a story, right? One of my favorite economists is Bob Lucas, PhD, Nobel Prize, and he said that economists are only storytellers. So let me go along with him and try to tell you a couple of stories. So how is the US economy, how is the global economy doing? The global economy actually is slowing down, but it's been slowing down for a couple of years. This is nothing new. As a matter of fact, it began to slow down in 2018. Actually, it's a synchronized growth, but at the same time, synchronized slowdown. It doesn't matter whether you look at the emerging markets, you look at the BRIC, right? Brazil, Russia, India, China. You look at Europe, the US, globally, all the economies slowing down. And last year, what we had was more of that. Particularly last year, we had a couple of big, large surprises, negative ones. Mainly in Europe, Germany, in Latin America, Mexico and Brazil, and India. Why did we have that? Right? Looking forward, what we see is that growth is going to continue to slow down. But when I love these maps because they, in a picture, they show you everything I think about the economy, right? Dark green is strong growth. Red is recession. Mild green is mild growth. And gray is, stagnation. And what do you see? You see that most countries are either gray, so growing below trend, or really light green, literally mild growth. So that's what we have going forward. So why do we have that? Constance mentioned this. We had the trade war. We had a trade war that led to a manufacturing recession. So globally, if you're in the manufacturing business, you feel you are in recession. And as a matter of fact, you are. And you've been for the whole year. And in particular, if you're in the auto industry in Germany, you've been in the deepest recession you've seen in the last 20, 30 years. So the question is, okay, will this continue? Constance mentioned it. When you look at the latest numbers, both China and Europe, it seems like we're bottoming out and things might pick up. But you know what happens, right? We had a trade war, and there's a saying, I come from Spain, in Spain where we say when two elephants fight, the guys who suffer are the mice, right? And that's what really happened in the global world in the last year, right? China and the US had a fight, right? The trade war, but they're really, actually their exposure to trade is actually low. Low compared to Germany, which is a manufacturing powerhouse, low compared to Mexico, low compared to almost any other country. So when you had this trade war between the US and China, the countries that actually suffered, and we saw those drops in the forecast growth, and they were close to recession, were countries like Germany, were countries like Mexico, even though Mexico, I'll talk about it a little longer for other reasons. So that's what we see. However, why didn't they go into recession? Because this time is different. That's the famous words that all economists like to say, right? This time is different. We always say that, and sadly enough, it almost never is. But this time it seems different. Services continue to grow. Non-manufacturing continues to do very well. Even in countries like Germany, which I decided to put here, with a really deep manufacturing recession, when you go back, normally, if you had a manufacturing recession in Germany, that led to a global recession. That led to a service recession. Not this time around. This time around, it seems like services are pulling manufacturing up, something that we haven't seen in the past. So that means actually I'm not that negative because things seem to be getting somewhat better, right? But in any case, we're still worried about recession. So are we going to have a recession? You know, when I don't have an answer, actually I haven't changed my forecast for recession in the last 4 years or 5 years. And it's always been the same, it's in 2 years. When is recession? In 2 years. Trust me, when I go to my executive committee in the company, I tell them recession, in 2 years. It's not going to affect the budget for next year, but it does affect the business plan for 5 years, right? But they don't like that too much. But the truth is that we've been postponing the recession every year for the last 4 or 5 years, right? So when is my forecast for recession? A year and a half to 2 years. It depends where, right? The truth is that when we don't know what the feeling is, what do? We Google it. So that's what I did. I figured that if I had no idea, I decided to bring this picture of the economists about recession. Guess what? This is from late 2018. We were all talking about recession back then, right? So I figured, I Googled it for last year, and what did I find? I found that we were all really worried about recession in the summer. There were recession in the papers everywhere. Everyone was thinking, okay, we have to plan for recession. But the truth is, since then, actually, we are not that worried anymore. It seems like things are going to be okay. And as a matter of fact, when you look at the mood in the articles, it was deteriorating all the way through the summer, and since then, the mood has changed and it's getting better. So So it seems like we're less worried. Not only, Google searches, but even our forecast for everybody seems to be postponing the recession once again, right? I think the message at the end is, look, a slowdown, for sure. We're slowing down. That's sometimes it's hard to explain that you're slowing down, but you're not going into recession. They're two different things, right? So the truth is that we have a slowdown, yes. Recession, that's not the same. And definitely a recession doesn't mean crisis. I think there is a big difference between what we're experiencing, which is a slowdown, recession, which we will eventually, if you ask me, have. Hopefully it'll be, long way down the road. It may be sooner than that. It depends on a lot of other shocks. We'll talk about them. But definitely it will happen. But what we are not likely to see, at least that's my forecast, and I'm sticking to it, but it's a crisis, in the short term, in the near future. I think the crisis that we had in 2009 or 2012, if you're in Europe, that was once in a century almost, once in a generation. And we're all very impacted by that, but that doesn't seem that the excesses are there for that to happen. Oops, what did I do? Oh yeah, here we go. So if we're not going to have recession, what do we have? We have a slowdown, but we have a slowdown globally. It doesn't matter whether you look at the US, in which the forecast here, I had the forecast range from Bloomberg, so besides my forecast to see that actually it's really stable growth, somewhere between 1.5 and 2 for the next 2 years. When you look at Germany or Mexico, who were actually slowing down and almost were in recession last year, actually Mexico, I would argue that it was actually in recession in 2018, they're actually picking up slowly. And even China, slow down. Actually, I'm not going to talk much about China because Constance knows much more about China than I do, and she already talked. There are some things like the coronavirus and whatever that may affect growth significantly, but everything else, all else equal, seems to be okay. So slow down, clearly, recession, no. What about another movie, Easy Money? The truth is that a lot of what's happening right now is on the back of really loose monetary policy, globally. Easy money, liquidity is abundant. So the question is, if that's the case, why isn't growth higher, or what are we doing with that? When you look at what monetary policy is doing, it's actually surprising us to the extent that a year ago, we were talking about tightening monetary policy pretty much everywhere. We were thinking, even in countries like Mexico, emerging markets, we were thinking that policy was going to tighten. And what we had is actually a reaction to the downside. Now we have looser monetary policy everywhere, particularly in Europe where rates are negative. Why is that? I call it a return to dovish land. It's not like, I don't know why it's a return because we never left, but it seems like we're going to stay here for a while. Why is that? First and foremost, there is no signs of inflation. So if a central bank who has, on the one hand, inflation, on the other growth, and has no inflation risks on the table, hey, he can concentrate on growth or anything else he wants. Why? Because, he's meeting his target in inflation. The second one, I'll talk a little bit about it in a second, is that the Fed is actually accommodating markets. I don't know whether I like it. Actually, I would argue that I don't like it. But it seems like the Fed doesn't want the market to come down. That keeps people happy, keeps the investment flowing, keeps consumption up through the wealth effect, and it's allowing growth. And the large part is the third one. We're still afraid of 2009. And therefore, we put a lot of weight on the tail risk. What if rates go up, right? Definitely the Fed doesn't want to be, or the ECB, the ones being blamed for causing the next recession. So given that fiscal policy seems to be relatively crazy almost everywhere, what the Fed, the ECB, the central banks are doing is saying, look, you're not going to blame me. Therefore, I'm going to keep accommodating policy also myself. My problem is that, as John Lingard said, you can please some of the people some of the time, you can please all the people some of the time, but you cannot please all the people all the time. Actually, I like much better the one for the sun. You cannot fool all the people all the time, right? And I think in a sense, eventually this will catch up with us. To begin with, we're looking at another movie, Vertigo, right? Stock market, record highs, and every time we look at it, it's even higher. But there's one really interesting thing, is every time the market corrects, guess who reacts? The Fed. Every time we have a correction in the market, the Fed loosens monetary policy or talks about loosening it. And that's what we have, and that's what we've seen. But let me tell you, this is not the story everywhere. When you look at other markets, namely in Europe, China, or if you're more specific, in the European banking sector, they're far, the Chinese market or the Euro banks, far from their peaks. And even the European stock market is now reaching their max. So it is true when we talk about markets that the stock market in the US is at record levels, not everywhere. Why is that? I would say there's obviously excess liquidity everywhere, buybacks, companies buying their own stocks, but there are two other factors that are important, and I think they do matter much more for the real economy. The first one is that financial investment by companies have been prioritized over physical investment. So, funny enough, we have an expansion in which investment in GDP is actually low. It's actually relatively quite low. Structures, whatever, it's actually very low investment. It's a growth without investment. Usually my best forecast for growth in the future is how much is the country investing. That's not working, because most companies are doing a lot of financial investments and not as many physical investments. And the second one, which may differentiate clearly Europe from the US, is the old versus new economy. The composition of the stock market in the US, the techs, are actually doing really well, thriving, while the old manufacturing powerhouses of Germany are having their troubles, right? So how long can this last? I wish I knew. If I knew. So for me, at the end of the day, the other country, the other large bloc is actually Europe. And the first question everybody says is, will the euro break up? I'll tell you the truth. I've been hearing about this for the last 10, 12 years, and there's always somebody who forecasts that the euro will break up in the next 2 years, right? Look, the euro will not break up, but don't expect the Eurozone to do a lot. It's like slow-moving snail. Decisions are taken really slowly. So what's the ECB going to do in this context? Guess what? What is the ECB objective? Obviously, if you read the ECB chart, it says it's got to be inflation. But there is one that is even more important than that, and that's maintaining the euro alive. Guess what? If the euro disappears, they all lose their jobs. The only reason for the ECB to exist is because the euro exists. So if you're Mr. Draghi, you say, believe me, it will be enough. It will be enough, because he's not only talking about the euro, he's talking about his jobs and everything that is been going on. What does that mean? That means, to begin with, that actually Greece interest rates are actually now lower than the US's. Yeah, I don't know about you, but that doesn't sound very, attractive to me. I mean, it sounds like kind of crazy that a country that was bankrupt not that long ago, look, that the rates went to 40% in 2012, 2013. Now they are financing themselves at a rate lower than the US. Why is that? Simple reason. They only have one buyer for their debt, and it's the central bank. So guess what? They really are, that market doesn't really exist. It's not a free market. The second one is that pretty much over 80% of debt in Germany, in the main countries in Europe, is actually traded at negative rates. Long-term debt. Germany is issuing 30-year bonds at negative rates. I don't know about, I'm an economist. I don't know anything about business or investment, but 30-year negative rate? Look, if I'm in government, I'll say, look, just put all the bonds on the world that you want, keep the principal and invest the interest. They're paying me to issue debt. And still, this is the way it is, and it's been for a while. So there are a lot of things here, is how low can the rates go? And they're lowering rates. These are things that actually don't add up. And when things don't add up, it comes to be Stein's law. When something cannot go on, it will stop. So there are things that really worry me about all this story. So how can this all last? Right? So we have really low growth, low rates, record stocks in a market with very low growth, record stocks, and this consumption versus investment dichotomy, consumption doing great and investment doing poorly. Why is all this possible? This is all possible as long as inflation doesn't pick up. If inflation picks up, the whole thing unravels. Central banks will have to react, and the whole thing will unravel. So hopefully, the truth is that if I could explain why inflation is low right now, I would, but I don't know. Right? It's a surprise, but I can give you, you're an economist. After the fact, we can explain everything. So I can tell you 10 reasons why inflation is low, but don't ask me to forecast it, right? So that's the problem. So let me go to a different movie, A Few Good Men. The world that we live in is a really strange world. It's a world in which political economy is dominating economic policy. And in that context, the room for policy error is huge. What we have nowadays is a world of very strong leaderships, which are quite unpredictable. Right? And the question is, how can we manage here? We have them everywhere. Sorry to say, from the US to China, to Indonesia, to India, to the Philippines, to Russia, and a lot of them missing. You don't see here Argentina, or you don't see here Bolivia, or you don't see here. So this is expanding everywhere. So to the extent that this is happening, how does this, I'm an economist, how does this affect the economy? Let me give you one example, and I'll bring it home a little bit, which is Mexico. If you remember from the graph I showed you before, right, with the exchange rates, with the interest rates, Mexico has a really high interest rate. Actually, the spread between the Mexican rate and the US rate is the highest in the emerging world, with the exception of South Africa. But the Mexico-US spread and the Mexico rate is actually the deepest and most liquid market within the EM world. So that's a great reason to invest in Mexico. So I love Mexico for several reasons. The first one is obviously my home base, actually the home base of my company, so I better look at it very carefully, right? Or I'm in trouble. Second one is because it gives you a really good example of how things look different when looked from abroad, from Wall Street, and how things look different when you look at the domestic decision-making process. And thirdly, and foremost, it's also very interesting that the decisions made by Wall Street investors who invest in bonds is not the same as the decisions made by operations who really thrive with the economy, right? So if you just want to make a quick buck, this is great. If you're just going to invest foreign direct investment in the country, you'd rather invest in an economy that's going to grow. What is the difference? Look, there are the forecasts up till December of last year, what the market, this is the market consensus, the Bloomberg, and the range from highest to lowest of what they thought the exchange rate would be. Guess what? In spite of that huge range, the actual number, the actual value has been outside the range. So the peso has been even more appreciated than people thought. That seems to be good news. That should mean that the economy is strong, right? And actually the forecast going forward is a peso which is relatively appreciated. Why is this? Obviously, there's support for global markets, high interest rates in Mexico, USMCA, which was approved, fiscal policy. There are a lot of reasons to believe. So if you're in New York and you're looking at the economy from abroad, you're saying, hey, this is the place to be. However, what if you're a domestic investor? What if you're Cemex or Walmart? Right? Guess what? That was the forecast for GDP growth for Mexico a year ago. Same picture as before. Growth of around 2% for 2019. What was the outcome? Negative growth. Actually, negative growth in the last quarter, zero growth for the year. Say, hold on, I have really low growth and appreciating exchange rate. They didn't teach me that in Econ 101, and it would be the other way around, right? If the economy weakens and whatever, the peso should depreciate. No, because This is caused mainly by domestic investors. Why? The private investment is on hold. Because of decisions made at the political level, political economy dominating economic policy, like canceling the airport and some other decisions, they just generate mistrust, distrust in the private sector, and they stop investing. And if the private sector stops investing, guess what? The economy slows down, and that's what happened. The good news is that the government has realized that. So they are beginning to open doors for further investment, even in the oil sector, which a year ago, everybody was told you that's impossible, that the government of López Obrador would open doors to new investments in oil. They will, they might. Why? Because they're afraid of this. At the end of the day, a government wants to win elections. And they know with the growth in Europe, they will not. So what do we expect for next year? Growth to pick up. Growth to pick up, but still relatively low, lower than it was before all this began. Why? Because you begin to trust the policy, but you're still a little wary. And investment tends to be wary when they don't see the future clearly. So politics do matter, and they do matter a lot. And finally, for the last movie, obviously I couldn't leave out Risky Business. It was one of my favorite movies back in the day. Yeah, for those of you who don't remember, you're actually quite young, I guess. We're living in a really risky world, right? And when you look at what's coming this year, Brexit tomorrow, I'm talking tomorrow, right? Then decisions, the Congress in China, more Brexit, the EU, decisions, all that matters, G20, elections in the US, and not only that, you have Hong Kong, Iran, coronavirus, and climate change, and so on and so forth. So you got a lot of risks on the table. And globalization, in shocks, is alive and kicking. I know a lot of people saying that globalization is on its way down. I don't know about that, but when you have a negative shock, everybody feels it, right? And things as, you know, the elections in the US, the question is not the election. The question is what a president, which is President Trump, which I would call strong and unpredictable, what will he do between now and the election? Will he announce, you know, he has, not that long ago, trade issues with Europe? That will impact the global economy. You know, just writing a tweet, he will have an impact. So there are plenty of things to worry about that may derail this expansion that we're seeing. But, you know, I tend to see the glass half full, so I'm optimist. So let me conclude just with 3 messages. Guess what? The economy is going to continue to grow, at least for the next year. You know, if you invite me next year, then I can tell you the same story again, because I've been saying the same story for 4 years. No, I'm kidding. There are no excesses, big excesses in Main Street. The excesses may be in Wall Street, but not in Main Street. For us to have a deep crisis, you need excesses in the real economy. And there doesn't seem to be that many. So even if we have a recession, it should be a really mild one, who cares, kind of thing. Second one is, guess what? Markets are addicted to easy money, to liquidity. And that means that assets tend to be mispriced. And usually when assets are mispriced, eventually they will be priced correctly. When? You know, you can ask an economist the when or the what, but never both things at the same time. So, and the last one is we have strong and predictable leaderships, and that gives a lot of room for policy errors. So mistakes coming from the policy domain that, you know, that are not necessarily driven by economic policy, that's the main worry. And obviously I had to finish with a movie, and given this, it couldn't be any other one than the good, the bad, and the ugly. Thank you.
Thanks, Manuel. That was a great movie. And it's now my pleasure to introduce Mervin Jebaraj. Mervin is the director of the Center for Business and Economic Research. He's an exceptional source of business and economic related expertise that journalists and business people alike rely on to understand how national and regional issues impact Northwest Arkansas and Arkansas as a whole. Please welcome Mervin Jebaraj.
Well, good afternoon, everybody. Well, thank you for that introduction, and thank you, Constance and Manuel, for your wonderful insights about how our economy is going to do in the next year, or as Manuel said, in the next 2 years, maybe, 4 years, as we're guessing. So I'm going to talk a little bit about how the Arkansas economy did in 2020. As you can see, I've titled my presentation, The Arkansas Economy in 2020. And you're thinking, well, it's the end of a decade and the start of a new one. I wonder if he's going to indulge in any nostalgia and look back at how we've done over the past several decades. Well, I won't disappoint you, that is. So we're going to indulge in all the nostalgia possible. It's basically going to be the Turner Classic Movies channel here. Who watches that? Anybody? There are no ads on the Turner Classic Movie channel, so it's pretty free movies. So let's start with our nostalgia immediately. The headline piece of good news in the Arkansas economy has been the unemployment rate. The unemployment rate hit record lows last year and remained there the entire year. The unemployment rate in 2018 for the state was really low. It got even lower in 2019. So that was spectacularly good news. Same story in Northwest Arkansas. The unemployment rate was really low and continued to decline in Northwest Arkansas and stayed at historic lows. So if you're looking at this chart and wondering, well, how long has it been this good? Well, that's 4% less. The unemployment rate is 4% lower both in Arkansas and in Northwest Arkansas. So from 10 years ago in 2009, which is when we were in the recession, we're doing a whole lot better. Now, if you talk to employers around our state, they'll tell you that employment costs have gone up, which is true. But the workers in our state are not complaining about this at all. So for the first time in Arkansas, we've had a significant wage growth. When you look at average weekly wages, on a nominal basis, unadjusted for inflation in Arkansas, that was up 5% in 2019 from 2018. So it's the first time since the recession ended that Arkansas has had that strong wage growth. So even if you adjust for inflation, you're still looking at wage growth above 3.5% in Arkansas as a whole. If you adjust for inflation and look at wage growth in Northwest Arkansas, that was more than 2.5% wage growth in 2019. So obviously Northwest Arkansas had gotten faster wage growth earlier in this economic recovery than the state as a whole. So this is what we were looking for with the low unemployment rate that stayed low in 2018 and in 2019. We're glad to have finally gotten the low unemployment rate and the higher wages. So if you're looking around the rest of our state, you see I've stacked all 6 metro areas in our state here. Pine Bluff's on the top, Northwest Arkansas is at the very bottom. 5 out of the 6 metro areas saw their unemployment rate decline. Pine Bluff being the exception, where the unemployment rate climbed just a little bit. In each of these areas, even though the unemployment rate went down in 5 out of the 6 metro areas, we didn't see strong wage growth in all of those metro areas that saw unemployment rate decline. So if you look at the top, Pine Bluff, the unemployment rate went up. Their wages declined about 5% in 2019, and that's unadjusted for inflation. Hot Springs, the wages went down about 1% last year, unadjusted for inflation, even though their unemployment rate went down. In Jonesboro, the unemployment rate went down, but wages only went up about 2% unadjusted for inflation. So once you adjust for inflation, there's really no wage growth. Little Rock had really strong wage growth. They grew about 4.6% unadjusted for inflation. So that was positive for Central Arkansas, the state's largest metro region. And so if you look around, even though most of these regions saw their unemployment rate decline, Fort Smith declined about 2.7% the wage growth. So, even in places where the unemployment rate went down, wages went down in a lot of the metro areas, with the exception, of course, of Northwest Arkansas. Little Rock and Jonesboro was essentially flat over the last time period. So when we turn around and look at what that did, the low unemployment rates for our labor force participation rate, which is something that you usually hear me complain about every year, you'll see that the Arkansas labor force participation rate still remains fairly poor, but it improved ever so slightly. It went from just below 58% to just above 58%. So at least we're headed in the right direction from this. And now when we look at where exactly this labor force gains came from, you'll see that I've put together the top 3 performing metro areas in our state. So you have Northwest Arkansas, Central Arkansas, which is Little Rock, and Jonesboro, which is Northeast Arkansas. You'll see that when the labor force participation rate declined in 2018, it was in large part because these 3 metro areas saw their labor force growth decline as well. One of them went to negative very briefly, but in general, all those 3 regions, the fast-growing regions in our state, saw much slower labor force growth in 2018. And so the reason why the state's labor force participation rate improved a little and the labor force grew a little in 2019 is because these 3 fast-performing regions saw their labor force grow again in 2019 and pulling up the state's overall labor force participation rate and labor force. On the other hand, you see the regions, the metro areas in our state that aren't growing as fast. Hot Springs is the exception here. Their labor force has consistently remained positive in terms of, so the labor force is growing there. Pine Bluff has hovered around that 0 line, and since the middle of last year is, very firmly showing negative growth in labor force. And the other exception there, obviously, you see Fort Smith. In November 2018 was the first time since, November 2019 was the first time since April 2018 that their labor force is positive. So for a very long period of time, over a period of more than a year, their labor force has been declining. So again, so when you look at the labor force participation increase in the state as a whole, really most of that work is coming from the 3 fast-growing metro regions, Northwest Arkansas, Little Rock, and Jonesboro, and in the recent past, it's also been the Hot Springs MSA. So that brings us to look at how we're performing in terms of employment, where exactly the jobs are coming from, and if you look at this chart, you'll see that towards the end, if you're not looking at the red lines, just the blue part, the employment growth has slowed a little bit, but 2019 was still better than 2018 in terms of employment growth for the state as a whole. In 2019, we added about 15,000 or so jobs statewide, which is, like I mentioned, faster growth pace than 2018, roughly on par with how we were doing in 2017, but definitely slower than that period we saw between 2014 and 2017, where the employment growth in the state was fairly fast. So now, over the next few slides, I'm going to go through and show you which sectors in the state the employment gains came from, and we're going to look at which regions of our state the employment gains came from. But before we do that, we'll look at the forecast. The red lines that you see are our forecast for employment growth in 2020, and you'll see it's positive. We're predicting something like 16,000 jobs to be added in 2020, and hopefully next year I'll make a whole bunch of 2020 vision was 2020 jokes, but I'll save those for next year. So our forecast for jobs is fairly positive. It has obviously the usual caveats both Constance and Manuel mentioned about state of the global economy, trade tensions, and et cetera, et cetera. But I do have a special caveat this year. When I was working on the forecasts, I visited a special exhibition at Crystal Bridges, and I got a lot of positive vibrations from them, and it kind of amplified my forecasts a bit. So please keep that particular caveat in mind. For those of you that don't take this seriously, I am joking about this. No crystals in my forecast. So which sectors did well in 2019? Construction, obviously on top. 20% of the jobs, the increase in construction came from here in Northwest Arkansas, but the rest of it was actually evenly divided around the state between the metro areas and non-metro areas. So all those highway bonds that we passed has provided quite a bit of short-term stimulus to various parts of our state. And last year we saw leisure and hospitality employment increase as well. We'll talk more about this in the next slide when we do a decade retrospective. Financial activities, almost all of this was increase in banking jobs, and almost all of it was in the Little Rock metro region. Manufacturing has had a short-term boom, especially in the last 2 years. So manufacturing is growing again in Arkansas as a whole, again, here 20% of manufacturing jobs too came from Northwest Arkansas, but the rest of it, like in construction, came from around the state, so fairly evenly spread out. Education and health services is mostly all healthcare jobs that we added. And towards the bottom, you'll see that we've lost mining and logging jobs, and that's been part of how the economy has been slowing in that particular sector over a longer period of time. So if you switch over to look at a decade retrospective, if you will, you'll see at the very top there is professional business services. It's led the growth over the last 10 years for our state. If you're wondering where these jobs were, well, 60% of that growth is in Northwest Arkansas. 20% of that growth was in Little Rock metro area. So about 80% of the growth really came from the two top performing metros in our state. So it was not very evenly spread out. And then over the last 10 years, you see leisure and hospitality do well as in our state. Obviously, our state's motto is the natural state, so there's plenty of fishing, hiking, hunting, mountain biking, and all of that available all across our state. But in addition to all of that, some of this employment increase is because places across our state have made significant investments in their downtown in concepts like placemaking. So if you think back to 10 years ago in 2009, the words placemaking and downtown revitalization was just something that the hippies in Fayetteville were going on about. Today, I'm one of those hippies in Fayetteville, I'm just putting it out there, okay? But today, it is a core plank in our economic development plan here in Northwest Arkansas and in several cities across our state. So not only does all the 5 major cities here in Northwest Arkansas have a downtown development plan, they've also invested in it. You see a lot of great activity in all those downtowns, but you're seeing the same activity in Little Rock and Conway and Jonesboro. Claiborne's from in El Dorado. You've done a lot of investments there at the Murphy Arts District. And other communities that you're not thinking about. Pine Bluff is working on a revitalization plan, and they probably have a casino going there, so that should improve their downtown. Little cities like Blytheville are doing that as well, so it's not just something that's happened here in Northwest Arkansas, it's something that's spreading throughout the state, which is why you see leisure and hospitality jobs are up. Financial activities, again, that huge increase is almost all banking, and almost all of that happened in the Little Rock metro region. Education and health services, once again, is almost all healthcare jobs, and about 2/3 of that job increase in healthcare happened after Medicaid expansion in 2014. So all of this is more recent than over the entire period of the decade. Trade, transportation, utilities is a much smaller component there, you can see, because for most of this recovery, retail trade has lost jobs. It started improving last year in 2019, but most of that decade, it has lost jobs. And then at the very bottom, again, you see mining and logging. So anybody remember the Fayetteville shale boom that happened? That was, it peaked in 2011. Today we have roughly half the number of jobs in Fayetteville shale that we did in 2011. So you see that huge decline there at the bottom from all that natural gas from Fayetteville shale. So let's look at where some of these jobs came from. I said about 15,000 jobs from the state as a whole. The Little Rock metro area in 2019 added about 4,000 of that to the net increase in the state. Again, in Little Rock, this pace of growth was faster than in 2018, roughly on par with 2017, but definitely slower than the pace of growth between 2014 and 2016. So if you think about where all those jobs are coming from, keep the math running in your head. We have 4,000 from the Little Rock metro area. Look at what sectors contributed to this employment growth. At the very top, you see education and health services. A huge portion of the healthcare jobs in our state that increased after 2014, obviously happening up in the central Arkansas metro area where we do have a significant healthcare cluster. Leisure and hospitality led as well. So again, it's not just outdoor activities, but the downtown revitalization efforts happening in central Arkansas. Financial activities, once again, that's mostly just banking. Trade, transportation, utilities, much more significant contributor to employment growth in the central Arkansas metro area. And then you see towards the bottom there, manufacturing in 2018, 2019 grew some. Again, that's more recent. It just grew in 2018 and grew in 2019, but not really before that. And then you see professional business services declined in 2019, in large part because there was an increase in temporary jobs, which is part of that sector, in 2018, and those went away in 2019. So again, looking at a 10-year retrospective for Central Arkansas economy, you see leisure hospitality at the very top, followed by healthcare. Again, most of that happened after 2014. Professional business services, banking, trade, transportation, utilities. And then if you're wondering why information looks so horrible at the bottom, information has very few jobs in it, so even 50 to 100 jobs lost shows up with an outsized effect on this graph. So most of those jobs obviously in news media, and we continue to see job declines in that sector. So let's look around our state and see how we're faring in different metro areas of our state. At the very top left, you see the Fort Smith metro area, lost about 300 jobs in 2019. And over a 10-year period, if you're wondering how Fort Smith has done, Fort Smith is roughly at the same employment level in 2019 that it was in 2009. And if you're looking at that chart, you'll see that the recession hit harder earlier in the Fort Smith metro area, so they lost most of the jobs in the front end of the previous recession in early 2007 and 2008, and then since 2009 has been relatively flat or very, very small declines. So over that 10-year period, they gained jobs in healthcare, they gained some professional business services jobs, they gained jobs in leisure and hospitality, but then they lost significant numbers of jobs in manufacturing and construction. In Hot Springs, the employment growth was about 600 jobs in 2019, and over a 10-year period, it was 1,600 jobs. So almost all of that growth happened just in the last year in Hot Springs. So that's good news for Hot Springs, but not a very even growth over that decade. In Pine Bluff, lost about 5,000 jobs over that 10-year period. It's been a very steady decline all the way from the last recession to this year, losing about 200, 300, 400, 500 jobs each year. Obviously, with the casino coming to downtown Pine Bluff and the revitalization efforts there, we hope to see some of that reverse. And then at the bottom right corner, you see the state's second best performing economy in terms of percentage growth of employment, and that's Jonesboro. They added about 1,100 jobs in 2019. And over a 10-year period, they added about 11,000 jobs. That's a 23% increase in 10 years. And they're second only, of course, to Northwest Arkansas. So we do have, just 3 pockets of really fast-paced growth in our state, which has remained a consistent story for us. Which brings me to Northwest Arkansas. So if you're thinking back to all the jobs I said, 15,000 for the state as a whole, 4,000 from Little Rock, 1,100 from Jonesboro. The rest of the job growth, the net job growth, a huge portion of that really came from Northwest Arkansas. So Northwest Arkansas had a weird 2019. The first half of 2019, when you looked at employment growth on a month-to-month basis, looking year over year, so January 2019 from January 2018 all the way to June, we were growing about 4,000 jobs, which is roughly half of what we've gotten used to over the last year. So, at least I was panicking in the first half of the year. The employment growth was a lot slower. But starting in June, employment growth on a year-over-year basis started going back to what we were used to, around 9,000 jobs a year. So when you average it out for the entire year, Northwest Arkansas added about 7,300 jobs in 2019, faster pace of growth than in 2018, but roughly on par with 2017, slower than 2014, 15, and 16. So because the job growth was actually slower last year, we saw our population growth slow down as well. And since it picked up in 2019, we expect to see going forward our population forecast to be a little bit closer to that 2.3, 2.5% growth in population that we've gotten used to. At the forecast there, you see a slightly faster pace of growth than in 2019, so we're predicting something a little north of 8,000 jobs to be added in Northwest Arkansas in the year 2020. I have my usual caveats for that, but I'm not going to do my chrysalis joke again. So at the very top, you see information there. Now, we had some increase in jobs from True Detective filming here. That was about 100 jobs. A lot of those kind of stayed. There's a little bit of a filmmaking industry going on in Northwest Arkansas. That's really just 100 or so jobs on 1,000 or 1,100, so it's not a huge sector of our economy yet. Professional business services is what really spurred the growth in the middle part of 2019 when professional business services growth picked up. that's when Northwest Arkansas's growth picked up as well. So that was great news. Those are your lawyers, accountants, engineers, architects, otherwise known as everybody sitting here in this room. And of course, you see construction at a third fastest pace of growth. There's plenty of evidence for this around our region. Jackhammers that wake you up in the morning, orange cones that alter your commute every day. Let me just tell you that this is about to get worse before it gets better. And by worse, I mean for traffic, not for the industry in particular. Industry is going gangbusters here. So, government employment is up. All of that is school teachers. Our enrollment at especially the lower levels has gone up. So those are all school teachers being added. Healthcare has gone up as well in Northwest Arkansas in the last year. Continues to grow in large part because our population is growing. So you see hospital expansions, new clinics, medical offices, exciting announcements from UAMS about their expanded residency program here in Northwest Arkansas, and the new Whole Health Institute that seeks to transform healthcare, not just here, but around the country as well. Financial activities, some jobs added in banking. Trade, transportation, utilities was close to negative last year. We've added retail jobs in 2019. We lost retail jobs in 2018. And at the very bottom is surprising to a lot of people. You see leisure and hospitality is slightly negative. Well, I said I wouldn't do this joke, but I'm going to do it anyway. That's largely because of the football season. I'm kidding. It's going to be a rebuilding years, something like that. Well, sorry. See, you can't make fun of the Razorbacks. You lose your slides. I don't know what I did here. Oh, we're back to the front. There we go. There you go. I learned my lesson. I won't do that again. So over a 10-year perspective, if you're looking at professional business services, at the very top, every year the professional business services led employment growth in Northwest Arkansas has been a year we're growing really fast, both in terms of population and GDP. Healthcare was the second fastest growing, leisure and hospitality followed, so all of those investments in outdoor amenities and downtowns really did boost leisure and hospitality. Construction followed, and it's going to continue to be a boom, especially with the construction of the new Walmart headquarters, government services, trade, transportation, utilities. And if you look at the 10-year perspective, manufacturing is a much smaller increase in employment, largely because all of those increases in manufacturing happened in 2018 and 2019 and not over the longer time period. So I've put together all of the employment growth by MSA on one chart so you could look at where all the growth is happening in our state. And I will draw your attention, obviously you look at Northwest Arkansas, we lost jobs during the Great Recession, and we more than made up for it. You look at Little Rock, lost jobs during the Great Recession, more than made up for it. That was the green line. The red line is Fort Smith, lost jobs during the Great Recession, did not make up for it, and you'll see that. And the kind of brown line at the very bottom, that's the rest of Arkansas. Those are the non-metro areas of Arkansas, and you'll see that they lost a lot of jobs, a lot more jobs than any of the other metros during the Great Recession. They had another mini recession when the Fayetteville shale boom ended and never really grew enough to make up for that job loss. So when you look at population growth statewide, it pretty much reflects growth only where the metro areas are growing, and most of the rest of the state, especially the non-metro areas, you see population decline. So if you're looking at this chart, any county that is not green saw a population decline between 2010 and 2018, the most recent years we have data for. So without the Northeast Arkansas economy, the entire eastern third of our state would have been in red. Without Sevier and Miller County, the entire southern third of our state would have been red. And to be fair, Sevier and Miller County, you're talking about a few hundred jobs over 8 years, which is well within the margin of error, so maybe they increased population, maybe they didn't. And so you see the really pockets of growth are in central Arkansas, where the economy has been doing pretty well, northeast Arkansas, where the economy has been doing pretty well, and up here in northwest Arkansas, you see the fastest population growth in our state. So it is important, obviously, this is 2020, we have a census coming along. There are a lot of resources available so that we can get an accurate count of for the census in our state as a whole, and here in Northwest Arkansas. Here are just some strategies. These are strategies from Engage NWA, which has a lot more resources at their website. about how to promote the census in Northwest Arkansas and around the state, get your businesses to participate and get your employees to participate in the census, and tell them the importance of getting an accurate count, not just in fast-growing regions like Northwest Arkansas, but also in the slow-growing regions around our state. So there are more resources available on the websites of Engaged NWA and Arkansas Counts. Please go to their websites and please pass them on to your friends, your community members, and to your employees. Now, on a lighter note, there's been a lot of speculation as to which city will be the second largest city in Arkansas. For a very long time, obviously Little Rock is the largest city in our state. That's not going to change. But for a very long time, Fayetteville has been on the heels of Fort Smith, trying to get to the second largest city in Arkansas. So to help you with all of this and to entertain you, I have started a betting market. You know, with casino gambling being legal, this is completely fine now. So you can place your bets before the census results are out. You can bet whether Fayetteville is finally going to get into second place and beat Fort Smith, whether Fort Smith's going to hold on for another year or two, or if you think there's a dark horse candidate out there, if you think Fort Smith's going to drop into fourth, Fayetteville's going to remain in third, and Springdale's going to jump past both of them into second place. You can place your bets. Rules and regulations are available on a website I've set up. If you want to take the website down, it's www.popecountycasino / if that ever happens. Thank you. Please write your questions on the cards and wave them around. Someone will come pick them up, and we'll be happy to include your questions as part of our panel discussion here. Thank you.
Hello. So, please fill out a question on the green card and it will be picked up. We'd love to have your questions. While that's happening, I will start with one which I changed in the middle of all the presentations for the first question. So there's a bit of a paradox. Markets are up, unemployment is at almost record lows, interest rates are low, but I note a definite note of caution. I won't say pessimism, but caution all of your outlooks, which were terrific, by the way. So if you could name, and Constance, I'm going to start with you, so I'm going to give you a second to think about this, a underappreciated risk in the economy that might derail this thing and might reflect this note of caution. Just one, but if you have to have two, give us two. We'll start with you, Manuel, and Mervin.
So thank you. Are we on? It says it's on.
Okay.
On? Yep. On. Okay. I was just stalling so I could think of a better answer. So I think what is underappreciated is how the confluence of risks come together and interact with one another, right? So if we just have one of any of the risks that I listed in my Jenga tower, it's very unlikely that would be enough to tip us into a negative growth situation. But it's how those risks interplay with one another that, to me, gets underappreciated and causes a regime change in terms of modeling. And to me, that is where the rubber meets the road in whether or not risks get realized.
Great, thank you. Manuel?
That's a great answer, so can I stick to that answer? And actually, I think Constance is right. I think there are two things. You know, it's easier saying two than one, right? First is inflation. The problem with the nice thing about inflation is we don't see it. So it's a very muted risk that nobody's expecting. However, if we do have it, things may unravel quickly. The second one, which is even more important to me, is the fact that the strong liquidity, the large liquidity, what has is that all asset classes are in the same boat. So if there is a shock, there is no refuge. right? So that means that the shock by a different channel than what Constance mentioned, if you have a negative shock, it's going to be augmented, and the impact obviously on markets will be quite large, but it will have also a large impact on the economy.
I think one, you mentioned political economy as being a risk, and I think one thing we don't talk about in the national economy is that I think partisanship is very well ingrained in our economy, and if you look at something like consumer sentiment, you have sort of a partisan consumer sentiment where Democrats feel very pessimistic about the economy, Republicans are very positive about the economy. So I think as we get into the fall and the election picture shakes out and we know who our candidates are and what the polling looks like, I think if people are worried, whichever side that is, you'll start maybe seeing some appreciable risk coming from that particular election scenario.
Thanks very much. One more, and that is we've done phase one of the China trade deal. Difficult, multi-year, it's been ongoing now for 20 years. It's been a difficult trade relationship. Phase one's done. That's the easy part. The hard part is intellectual property and how it's transferred or not transferred, and state subsidies of various industries in China. How does that get impacted here? So, what do you think the odds of the gnarly hard part being resolved? Constance?
Thank you. We on? Okay. So I'll start by saying that phase one has been penned and signed, but as I noted, those are some really steep hurdles to meet. So before we even get to phase two, what we need to assess is how strict the U.S. will be in enforcing phase one. Will they cut China some slack? Will they be a little flexible? Or will they come back and say, well, you didn't agree to phase one as we're in the process of negotiating phase two, so we're going to tighten the screws and turn up the heat. So I think before we even assess phase two, we need to understand that phase two is likely to occur in a background of phase one targets not being met. If phase two weren't difficult enough, that adds a layer of complexity. And in terms of phase two, these are very, very tricky things. So I'm fortunate enough to participate in the National Committee for U.S.-China Relations Track 2 Economic Dialogues. And we meet twice a year, U.S. and Chinese economists, and we make recommendations to our governments. And while this trade negotiation has been going on, and understand that the Chinese economists that are participating in this tend to be the so-called reformer economists. They're the ones who were educated in the United States. They're in favor of China moving more towards a market economy. And so even they, when they look at the way that China is conducting things, think that there is not a lot of room for movement now under the Xi regime away from state-owned enterprises, state-championed companies. The party has gotten much more clear about saying that all companies in China serve the state and serve the party. And so instead of having the trade negotiations move China further towards us, what we have seen is that China has moved, in terms of rhetoric, a little bit further away. And so, as you point out, these are very hard things to negotiate, and I think it's not going to be easy going. So it'll be interesting what spin the administration puts on this and where the pressure points are for the U.S. to soften their stance a little bit. And I think in terms of security, so the CFIUS process and assessing security risks are not going away, they're going to increase. We're going to see that have a geopolitical impact. So, for example, the UK has allowed Huawei to participate in 5G in the UK. That's something that we really encourage them not to do. So there are a lot of things where I think it is unlikely we're going to see much flexibility on our side. And there are a lot of things, both economically and from an ideological perspective, where I don't think we're going to see much movement on the China side.
Okay. I'm actually going to switch now because I got a question from the audience which really piqued my curiosity. This is kind of an interesting one. How will the two outcomes of the impeachment affect the economy? One, Trump out. Two, Trump in. Mervin?
Well, I think, as I mentioned, the partisan consumer sentiment index, I think definitely in the very, very unlikely scenario that he is impeached, I think you will see the economy slow down because, one thing, irrespective of all the trade wars and things that have gone on, the regulatory environment for businesses has been very lax, and businesses have enjoyed that over the past few years, and they think that that's going away. I think you'll see almost an immediate pullback in business investment, which really has been low as it's, as far as it goes. So, and if he stays, I think you'll get more of the same until the fall, until we get some polls in the general election.
Manuel?
Same question? Gee, I thought you were going to ask something different. As a foreigner, I have a little more freedom to say
That's why I wanted to hear you
think.
That's why I wanted to hear your view.
No, the truth is, it seems difficult to see how the impeachment will go forth, right, given the numbers. However, for me, looking at it from outside, I think the impact on the economy might be large or could be, depending on how the impeachment proceeds, regardless of the final outcome. If things get tighter, President Trump is likely to find somebody or a different enemy, let's put it that way, and that may be trade with Europe or Iran or something else, right? Or China, right? I mean, I think the Chinese, talking to Constance, it goes beyond trade. We're only talking about trade, but it goes well beyond trade. It's Hong Kong, it's relations, it's Game of Thrones. I mean, it's the two largest powers fighting for. So if he's in or out, doesn't matter. If he's in at the end, it depends what the election outcome and the impact, what the impact of the impeachment has on the likely candidate on the Democratic side, because that may affect the economy. I'll go further than that. If at the end of the day you have President Trump remaining in power, you'll see more of the same going forward for the next few years. However, if you have a change in government, we might have a few shocks. Probably there is the green agenda, which has been off the books for 4 years, will come back into the table, right? Health issues will come back onto the table. There will be a lot of new directions which will generate uncertainty, at least in the short term. So we'll have to deal with all that.
Constance.
So I guess if we get to the point where Trump is removed from office, that can't happen without Republican support. It would have to be bipartisan. And what we saw during the Nixon impeachment, of course, we never got this far. Nixon decided to resign before all the evidence ended up coming out, although, of course, it came out in rather substantial way that caused him to do that. If we have more evidence come out, for example, from a Bolton testimony or other sources, and we have Republican support in the Senate increase for this, the question mark is, if Trump goes, how does he go? Does he resign before it gets worse, or does he stay and fight? And I think if we have something like Nixon, where we have evidence that changes hearts and minds on the Republican side, then we have a fairly benign economic outcome. If we have a recalcitrant reaction to a shift in hearts and minds from the Republican coming from the White House, I think that is a greater fallout.
Interesting perspective. Okay, I like this one. This says, for Deming, forecast for oil price 2020 and 2021. I'll preface this by saying I've been in and around the oil business for 40 years, never got it right. Having said that, there's plenty of oil and plenty of natural gas in the world. So likely, unless there's a geopolitical event, and that only might be a temporary spike, we're definitely range bound. So the high ought to be upper 50s at best. If we get a spike lower, below 45 bucks, the industry doesn't make enough money to make investment, and then supply gets threatened, so price goes up. So somewhere in that range is where it's likely going to be. And the geopolitical event, we already had one in Saudi, had one in Iran, and it temporarily spiked and came down. So the geopolitical event would have to be significant, like blockage of the Straits of Hormuz, for example, before there'd be some sustained increase. So I don't think that's going to be a drag on the economy. Okay, here's one that I think is important generationally, and one that at least I think is ultimately a real threat to our country. So what are your thoughts on the level of the national debt? We just had a news story that we're at $1 trillion a year now, almost unthinkable even 10 years ago. And how do you think that's going to influence our future economic growth as a country? So I'm going to start with you, Manuel, since I haven't started with you yet.
Not just in the U.S., I think the amount of debt that we're accumulating is a real threat for most economies globally, right? Constance mentioned China, but we can talk about the US, we can talk about almost any country. Obviously, with rates at 0%, almost anything is sustainable. But when rates are not, eventually they will not be zero, then we got a problem. So that's clearly the case. But at the end of the day, what you have is, I mentioned it before, right? It's a Stein's law. If something cannot go on, it will stop, right? And what we did as countries, or in response to the previous crisis in a sense was a debt crisis. And somehow we came out of the debt crisis, we solved the debt crisis with more debt, right? Which is not, it doesn't sound very logical, but it worked, right? Or it seemed to be working. Question is that sustainable? Yeah. It forces interest rates low for much longer than needed, likely. So we are getting into danger. The more we accumulate, the more dangerous territory we're getting into.
Okay. Well, our time is almost out, so I'm going to ask you one last very significant question, but I want a short answer. Are you optimistic about the future? Why or why not? Mervin, I'll start with you and all three.
As a millennial, we're supposed to be very pessimistic about the future, but I'm not. I mean, I think there are so many of us out there that haven't hit the full stride in our economy yet, so I think the future is likely very positive for us. Obviously, some big caveats around climate change and other big issues that we haven't resolved, but I'm generally very optimistic about the future of our world economy.
Myself, as an economist working for a company, it pays to be pessimist because when you're right, and everybody says, "Oh, you were right," and when you're wrong, nobody cares, right? So it pays to be pessimist, but I have a hard time being pessimist. I think we got challenges in the short term, but I'm relatively more optimistic in the medium term. I think we haven't seen anything yet with respect to the tech change and productivity impact that all the new technology, artificial intelligence, and so on and so forth in health and living standards. I mean, there's one thing Constance said is that it's funny because it's not funny actually, it's sad. The US is one of the few countries in which life expectancy is coming down, but of the developed economies, it's the only country where life expectancy is actually coming down. The rest of the economies is actually going up, right? So there are a lot of new opportunities and there is a lot of new businesses, and we're in a transition period. And transitions are always hard, they're always tough. But once you go through them, you're in a different level playing field, and so I'm an optimist.
Good. Constance?
So they call economics the dismal science. And I think it's because of what Manuel said, right? If you forecast a risk or a pitfall on the road, and you're right, everybody thanks you and says, thank you so much for letting us prepare. But I really think that what we see in our business and with our clients is companies, even though the top line investment number is not high, we see lots of investment in labor saving productivity. We see lots of investment in software and products that are going to improve information gathering and usage of information. And I think we are just on the cusp of that becoming a general purpose technology that infuses the whole economy. And the life cycle of these things is long. So if we think about the time frame from when electricity was invented to when it had a wholesale change in the way our economy operated, that was decades. And so we are just entering that. We have challenges. Mervin mentioned climate. We have obviously the debt challenge, not just here in the US, but globally. But I think that when we think about everybody in this room and how all of us are working towards meeting challenges in our daily lives, in our jobs, for our communities, I think that when you have everybody focused on something, the odds are you will prevail.
Great. Well, that's 3 for 3, which I appreciate. So, Matt, I think our time is up, and there was a number of climate change questions directed at moi. And if I stay out here longer, I'll have to address them, and that's a really difficult issue. So I'm going to pass the mic to you.
Claiborne, Constance, and Manuel, you three did a terrific job. Thank you so much. In your honors, we are going to give $500 scholarships in your name to students at the University of Arkansas. You'll get bills later. Just kidding, that's not true. But seriously, we really appreciate it. And Mervin, you have been doing a great job since the whole time you've been doing this. We really appreciate you. Let's give Mervin a hand. And one person who's really strategic in making this successful year after year that many of you don't know about her involvement is Marianne Greenwood. Marianne, would you stand up? Let's give Marianne a hand. I also want to thank Jeff Cooperstein, Mary Davenport, David Sordo, and the rest of the Walton College staff for all of the hard work in making this happen. Let's give them a hand. Thank you all for coming, and you're dismissed.